Here is the uncomfortable truth that nobody in your neighborhood, nobody at your bank, and certainly not the mortgage industry wants you to understand. Paying off your mortgage early might be the single most expensive financial mistake that responsible, hardworking Americans are making right now. Not because they are careless, not because they are reckless, but because they are doing exactly what they were told to do. They are being financially responsible in exactly the way society taught them, and it is quietly costing them tens of thousands, sometimes hundreds of thousands of dollars in long-term wealth. Think about that for a moment. You are doing the right thing. You are throwing extra money at your mortgage every single month. You are proud of it. Your parents approve. Your neighbor thinks it is brilliant. You are watching that principal balance shrink and feeling a warm, unmistakable sense of control and security wash over you. And it feels like winning. It feels like the kind of disciplined, mature financial decision that separates responsible adults from people who end up broke and bitter in their 70s. But what if the scoreboard is wrong? What if the very feeling of financial virtue that comes from paying down your mortgage is actually masking a massive, ongoing, invisible transfer of wealth out of your future? What if the peace of mind you are buying with every extra mortgage payment is, in fact, the most expensive peace of mind money can buy? What if everything you were taught about owning your home free and clear is, at best, incomplete, and at worst, completely backwards? That is exactly what I am going to show you today. Almost every American who grew up in a middle-class household absorbed the same core message about mortgages. Own your home. Pay it off as fast as you can. A paid-off house means security. A paid-off house means freedom. A paid-off house means you made it. This is not fringe advice from some obscure corner of the internet. This is the backbone of mainstream American financial wisdom. Major financial voices with tens of millions of followers have built entire careers on this message, telling people to throw every spare dollar at their mortgage until it is gone. Cut up the credit cards, drive a used car, skip the vacation, and attack that mortgage like it is, the enemy standing between you and a comfortable life. That message, to be fair, comes from a genuinely good and well-intentioned place. After watching families lose their homes during the financial crisis of 2008 and 2009, after witnessing the psychological devastation of foreclosure and the collapse of home values in so many communities, the idea of owning your home free and clear feels not just financially wise, but emotionally necessary. Nobody wants to lose their home. Nobody wants to lie awake at night wondering whether one bad month at work means they lose the house. That fear is completely human, completely valid, and completely understandable. And so the advice became gospel. A paid-off mortgage equals safety. Extra payments equal discipline. Mortgage freedom equals financial freedom. This belief spread through households, through financial education classes, through church money management programs, through well-meaning relatives at Thanksgiving dinner. It became the respectable, responsible thing to do. According to the Federal Reserve's survey of consumer finances, the primary residence represents the single largest asset for most American households. Home equity accounts for a dominant share of total household net worth for families in their 40s and 50s. When your biggest asset is your home, the instinct to make that asset as large as possible and as unencumbered as possible feels like simple logic. More equity means more security. More equity means more net worth, right? That is the belief, and it makes perfect sense on the surface. The problem is that the surface is not where long-term wealth is built or lost. Wealth is decided by the mechanics operating quietly underneath. So here's the question that starts to crack this entire worldview open. If paying off your mortgage early is such a powerful wealth-building strategy, why do financial researchers who study actual household wealth data consistently find that mortgage-free households are not always the wealthiest households? Why does the data show that the families with the largest home equity do not necessarily retire with the most money? Why do people who follow the pay everything off advice sometimes arrive at retirement with a beautiful, debt-free home and a retirement account that is too small to support the life they want to live? If the advice is so good, why do so many people who follow it diligently still find themselves financially constrained at the exact moment in life when financial freedom should feel closest? Something does not add up. And once you see what that something is, you cannot unsee it. The core mechanism at work here is called the opportunity cost of capital, and it is one of the most important and most widely ignored concepts in personal finance. The idea is straightforward. Every dollar you send to your mortgage servicer as a prepayment is a dollar that has now permanently exited your financial life as an active working compounding asset. Once it goes into your home's equity, it is locked up. It cannot grow, it cannot compound, it cannot generate returns. It simply sits inside the walls of your house, doing nothing financially productive whatsoever until the day you sell the home or take out a loan against it. Here is the part that genuinely shocks people when they first understand it. Your home's value appreciates based on the market value of the property, not based on how much equity you hold in it. Whether you owe $180,000 on a $350,000 home, or you own that same home completely free and clear, that home will appreciate at the exact same rate. It does not matter at all, from the perspective of the asset's growth, how much you owe on it. The equity stake you have in your home earns you nothing extra. What earns you money is the asset's appreciation, and that happens identically regardless of your mortgage balance. So the real question is not how fast you can pay off your mortgage. The real question is this: what is the most financially productive thing you can do with every extra dollar you have right now? And the answer almost always involves a direct comparison between two numbers. Your mortgage interest rate on one side, your expected long-term investment return on the other. If your mortgage carries an interest rate of, say, 4%, which millions of American homeowners locked in between 2020 and 2022, and a diversified portfolio of low-cost index funds has historically returned approximately 7% annually over long periods of time on an inflation-adjusted basis, then every dollar you send to the mortgage instead of investing is costing you approximately 3% per year. That 3% difference does not sound dramatic in isolation, but compounding magnifies everything. Over 20 years, that gap in annual return does not add up. It multiplies. And the result is a difference in net worth that most people never see coming because they were never shown the math. Financial research on household optimization consistently shows that homeowners who carry a low-rate mortgage and invest the difference in diversified equity portfolios accumulate dramatically more total wealth over 10 to 20-year periods than homeowners who prioritize mortgage payoff. The gap in total net worth, even after accounting for the additional mortgage interest paid by the investor, can reach well into the six figures for a household with median American income. Not because they took wild financial risks, because they understood the basic arithmetic of compound growth versus the cost of low-interest debt. And here is the additional layer that most people do not even consider. For American homeowners who itemize deductions on their federal tax returns, mortgage interest is deductible, meaning the Internal Revenue Service effectively subsidizes the cost of carrying that debt. After the Tax Cuts and Jobs Act of 2017 significantly increased the standard deduction, fewer Americans itemize today than in previous decades. But for those who do itemize, particularly those with larger mortgage balances in higher tax brackets, the after-tax cost of that mortgage debt is meaningfully lower than the face rate suggests. A 6% mortgage for someone in the 24% federal tax bracket who itemizes has an effective after-tax cost of approximately 4.5%, which makes the investment case even stronger. Now, you might be asking yourself a very fair question. If the math is so clear, why don't more people realize this? Why is paying off the mortgage still the default advice that so many Americans follow without questioning it? The answer lives in the psychology, not the spreadsheet. And the most important concept to understand here is something behavioral economists call loss aversion. This idea, developed through decades of research by psychologists Daniel Kahneman and Amos Tversky, research that earned a Nobel Prize in Economic Sciences in 2002, demonstrates that human beings experience the pain of a loss approximately twice as intensely as the pleasure of an equivalent gain. In simple terms, losing $20 feels about twice as bad as finding $20 feels good. We are emotionally wired to avoid losses more aggressively than we pursue gains. Debt triggers this response powerfully. Carrying a mortgage does not feel like a neutral financial tool. It feels like a weight. It feels like exposure. It feels like something that could be taken from you. And so the urgency to eliminate it does not come from rational financial calculation. It comes from the brain's ancient, deeply hardwired threat response system. The mortgage feels dangerous. Paying it down feels like safety. And that feeling is so real, so biological, so immediate, that it overrides the calm, long-term math almost every time. There is also a deeply embedded social dynamic at play. In American culture, owning your home free and clear is a milestone with enormous symbolic weight. Mortgage burning ceremonies are a real tradition. Announcing that you paid off your house triggers genuine admiration from friends and family in a way that saying, "I maxed out my index fund contributions for the 23rd year in a row," simply does not. The social reward for mortgage payoff is loud, immediate, and deeply satisfying. The social reward for disciplined long-term investing is essentially invisible, which means it requires ignoring the social feedback loop that your brain is constantly scanning for. You were not foolish for following this path. You were responding to deep psychological programming and legitimate cultural signals that were all pointing in the same direction. What most people never get is the permission to question those signals with actual math. Let me make this concrete with two real American households. Meet Sarah and David. They are both 43 years old, both earning $90,000 a year. They both bought a home 7 years ago for $320,000 and currently carry a mortgage balance of $210,000 at a 4.25% interest rate. Both households have about $600 a month that they can direct somewhere financially productive after covering all their baseline expenses. Sarah and David follow the conventional wisdom. Every month, they send that $600 as an extra payment directly toward their mortgage principal. They are disciplined, consistent, and feel genuinely good about watching their balance drop. At this pace, they will be completely mortgage-free in approximately 13 more years, right around age 56. Now meet Marcus and Lisa. Same age, same income, same exact mortgage. But they took a different path. They make only their required monthly payment and invest that same $600 every month into a low-cost total market index fund in their tax-advantaged accounts. They do not think about the mortgage much. They think about the portfolio. Fast forward 20 years. Sarah and David own their home free and clear. Their home, appreciating at a modest 3 to 4% annually, is now worth approximately $580,000. Their retirement accounts, however, are considerably smaller than they could have been because they spent 2 decades directing investable capital toward mortgage payoff instead of market participation. Marcus and Lisa still have a small remaining mortgage balance. But that $600 per month invested consistently over 20 years at a 7% average annual return has grown to approximately $310,000 in their investment portfolio, on top of whatever their regular retirement contributions produced. Their total net worth, combining their home equity with their investments, substantially exceeds Sarah and David's. Depending on sequence and timing, the gap can be $150,000 to $250,000 in favor of the family that chose to invest. Same income, same home, same discipline, completely different destination. The only variable was where the $600 went every single month. So what do you do with this information right now? Let me walk you through a practical framework, step by step, that you can begin implementing this week. Start with your hurdle rate calculation. Pull up your mortgage statement and write down your exact interest rate. If you itemize deductions on your federal tax return, subtract your marginal tax rate from 1, then multiply by your mortgage rate. That gives you your effective after-tax cost of carrying the mortgage. For most people with rates below 6%, this after-tax cost will land somewhere between 3 and 5%. That is your hurdle rate. Any investment vehicle that reliably returns more than that rate over time beats prepaying your mortgage mathematically. The second step is to fully fund your emergency reserve before redirecting a single dollar. You need 3 to 6 months of essential living expenses sitting in a high-yield savings account or money market account that you can access immediately. This is non-negotiable, and it is not in competition with everything else we are discussing. It is the foundation. Home equity is completely illiquid. If your job disappears and all your extra cash is locked inside your home's walls, you cannot access it without selling the house or taking out a new loan. You need liquid savings as your buffer. Build that first. The third and most powerful step is to exhaust every available tax-advantaged investment account before you make a single extra mortgage payment. Start with your employer-sponsored 401(k) retirement plan and contribute at minimum enough to capture every dollar of your employer's matching contribution. If your employer matches dollar for dollar up to 5% of your salary, that is an automatic, immediate 100% return on that portion of your contribution before it ever enters the market. No mortgage payoff strategy competes with that. After the full match is captured, contribute to a Roth individual retirement account. In 2025, the annual Roth contribution limit is $7,000 for individuals under 50 and $8,000 for those 50 and older under the catch-up contribution rule. The growth inside a Roth account is completely tax-free, not tax-deferred, but genuinely and permanently tax-free. The long-term value of that tax treatment, compounding over 15 to 20 years, is extraordinary. The fourth step is a simple but important gut check about your current rate. If your mortgage rate is below 5%, the mathematical case for investing the difference instead of prepaying is extremely strong in nearly any reasonable market scenario. If your rate is between 5 and 7%, the decision becomes more nuanced and more personal. Your risk tolerance, your age, your years to retirement, and your psychological comfort level all deserve real weight. If your rate is above 7%, the calculus shifts meaningfully toward considering payoff, because guaranteed debt reduction at that rate starts to compete more seriously with uncertain market returns. Be honest with yourself about where you stand. The fifth step is to automate, because the decision you make once is always more powerful than the decision you try to make every month. If the extra money lands in your checking account and requires a conscious choice each time, loss aversion will eventually win. Your brain will manufacture a reason to pay down the mortgage when the market has a bad month or when financial stress is elevated. Remove that decision from your monthly to-do list entirely. Set up an automatic investment transfer that fires on the same day your paycheck arrives. Treat investing like a fixed expense. Make it invisible and non-negotiable. Now picture what your financial life looks like a decade from now if you implement all of this consistently. You are 53 years old. Your home has appreciated steadily, the same appreciation it would have had whether you carried the mortgage or not. But for the past 10 years, instead of sending extra money into the illiquid equity of your home, you were compounding it in the market. $500 to $600 a month invested at a 7% average annual return over 10 years grows to approximately $87,000. And that $87,000 does not stop working at year 10. It continues to compound every year after that, generating growth on growth on growth, all the way through your working life and into retirement. Project that forward to age 65 and the difference becomes staggering. Two versions of yourself arrive at retirement with the same house, both of equal value. But the version of you that chose to invest the difference has a retirement portfolio that is $250,000 to $300,000 larger. That is the difference between a retirement that is comfortable and one that gives you genuine freedom. The ability to leave money to your children, to travel without anxiety, to deal with a health crisis without financial devastation, to live on your own terms without watching every dollar out of necessity, and the version that paid off the mortgage early. They have a beautiful, debt-free home and a retirement account that makes every major decision feel tight. Same discipline, same sacrifice. Radically different outcome. The truth at the center of this entire conversation is simple. Your home is not a savings vehicle. It is an asset that appreciates at whatever pace the market dictates, regardless of your mortgage balance. The equity inside it cannot compound, cannot grow on its own, and cannot generate income until you sell or borrow against it. Money that compounds in a diversified investment portfolio, on the other hand, works 24 hours a day, 7 days a week, growing on itself year after year. Choosing between those two destinations for your extra dollars, is not a complicated decision once you understand what each one actually does. The single most important thing you can do today, not next week, not after you finish reading one more article on this, is to pull up your mortgage statement, write down your interest rate, and compare it honestly to what your uninvested dollars are currently earning. If you have money going toward extra mortgage payments each month and your rate is under 6%, you now have the information to redirect that capital toward long-term compounding wealth. Open the account, set up the automatic transfer, make the decision once, and let time do the rest. You now understand something that most of your neighbors, most of your coworkers, and frankly most financial advisors never clearly explain. The question was never whether you should own your home. The question was always what you do with the extra money. And now you know the answer.